This is the briefing for Friday, February 2nd. This was one incredible day in the markets. To say the least, I was just very, very shocked that we didn't see the market come tumbling down going into the close, although we did see a little bit of a sell-off. This is the spiders on 60-minute, the Qs on a 60-minute, and the Russell on a 60-minute, and this is the reason why. If you look at, this is the open on breadth and the spiders. Actually, this is the NYSE breadth. And you can see, if you look up the crosshairs, you can see where the open was in terms of price. Now, we were at 1,457 shares negative, 1,500 shares negative on that opened higher than yesterday. And while breadth recovered some, we still closed negative 1,000 shares more on the NYSE than were positive. So you can see that this move here was not fueled by internal strength. Volume in the spiders was basically muted. Look at the NASDAQ, the Qs, opening up right at about 1,500 shares negative also, gapped up, stayed fairly negative for most of the day, a little bit of improvement closing down about 946 shares. But you can see this move here. I was just astounded to be able to see price move the way that it did. And then, of course, this is the Russell, the IWM, and it really performed in terms of divergences between price and the internals a little bit better, even though it did not take out this previous high, which the other two indices did. So we have huge internal divergences, and we have huge intermarket divergences that is going to be very interesting to see how this is all reconciled next week in next week's trading. I was really very, very stunned to be able to see price push as high as it did on low volume and negative breadth. Now, that told me one thing, that the possibility was that the higher weighted stocks were carrying the market and carrying the averages higher. Now, we do know that I think it was Amazon and Meta blew out their earnings today. So certainly that had an impact on it. So what I did was I went to this is the spiders on a 15-minute basis, and this is RSP, which is the S&P 500 equal weighted. So this is a weighted average with some of the stocks in it that are given a higher weighting, and this is equal weighted. Every stock's being equal weighted. The thing to look here is this is the January 30th high in the spiders. This is the January 30th high in the RSP equal weighted. So if you look here, if I drew a trend line across here, you could see that the spiders, the highly weighted, or the weighted spiders, weighted S&P, has been really on fire, led by higher weighted stocks. Look at where the equal weighted index is. It's basically right at the January 30th high. So you can see the divergence between these based on the fact that the higher weighted stocks, at least in today's trading, are carrying the market to new highs. It's influencing price development. The question is that sustainable? I don't believe it is. Now, I've discussed this previously, and I use it for psychological purposes. It's not statistically correct. But when I see internal divergences, I just assume that it's about a 70% chance that the price will correct to the internals, and a 30% chance that the internals will correct to price. The internals typically correct to price around a news event. So we had some pretty big news this week, which certainly spurred the markets. We had a move down on Wednesday, and then a gap down on Thursday, and then of course the rotation back up in today's trading. But I really would expect to see some type of consolidation or some type of move back to the downside sometime next week based on what I'm seeing in the internals. I'll get to a little more of that in just a few minutes. I'll just do it now. The other internals that I watch, as most of you know, this is the S&P 500, the percentage of stocks above the 50-day moving average. You can see what's happening here. You can see the deterioration that's occurred in the S&P 500 itself. and this is the S&P 500 above the 200-day moving average. And you can see the deterioration here. Now, a little bit of recovery right in through here, but keep in mind that the 50-day moving average is going to be quicker, I should say, to react than the 200-day moving average. So this is telling me that this is probably going to begin turning back down again. As we saw even in today's trading, it turned down. Looking at the NASDAQ percentage above 50-day moving average, percentage of stocks above the 50-day moving average, you can see the deterioration that's occurring. 200-day moving average, once again, some deterioration, but it's going to be a slower movement than in the others. And in the Russell really signaling some deterioration. This is pretty significant that we've seen almost this whole part, this rally. You can see how this rally here was supported by this move here. And now what we have is we have this move here in the Russell going to the downside, and this move here, and of course more deterioration in the 200-day moving average as well. It's really a little bit surprising to me to see the Russell holding up as well as it has been. But things to watch for in the Russell, especially, and I'll get to that a little bit later, is this 190 area is going to be really important, and then below that's going to be about the 187. And the same thing here, you can see this 190 area, and then below that is that low there. So if those prices are broken, that's going to probably begin to weigh on the other indices as well. I would watch the Russell. I should say I watch the Russell to give me early potential warning signals of potential move in the other indices, and it proves fairly successful to point out the divergences with the Russell and the other indices. And that gives you somewhat of a little bit more information from the market to a potential turning point, whether it's to the upside or to the downside. This is the daily chart on the spiders. So you can see this is about 491. 491 area is now support. We're at new all-time highs. You can see what happened with volume. You can see the breadth divergence. 52-week highs minus 52-week lows is still deteriorating. So really no strength coming in the market on today's rally. Same thing with Q's. Q's volume is extremely low. You can see the divergence in NASDAQ breadth as well, and the same thing with the Russell. You can see the volume falling off in today's move. And you can see Russell didn't even make a new high above the previous day's high. Breadth deteriorating, 928 shares negative in the Russell 2000. This is the IWM, so it is the Russell 2000. Looking at where we are in terms of overbought and oversold now, I don't have the price up here, but you can see the divergence here even with the indices. If I had the price candle chart of price up here, you'd see the deterioration that's occurring even in this overbought and oversold indicator. So we're approaching oversold, but that basically was a result of the negative breadth divergence that we saw in today's trading. Looking at total volume, you can see NYSE total volume is really right at the upper range of what is typically medium volume. And look at volume in the NASDAQ. Volume in the NASDAQ has been declining all through this rally here, declining even more in today's trading. So where we are is we have a divergence between the NASDAQ and the Russell, and we have a divergence between the S&P, the NASDAQ, and the Russell. So it's difficult to determine how these intermarket divergences get resolved, but they typically get resolved. I would suggest that with the Russell 2000, with the NASDAQ with about 3,500 shares in it, that potentially we're seeing more stocks beginning to trade to the downside than to the upside. Also, there was an article in Zero Hedge which was very interesting. I think it was yesterday, that talked about how all the institutions, as we went into the highs of last week, were selling pretty dramatically. So it's going to be very telling as to what we see in next week's trading. But I would approach next week with a lot of caution. I've put a small short position on, and I will take that off if we trade above today's high. And I will add to that position if we begin trading through the shorter term support levels and then into the intermediate term support levels, which are these levels here. I will add to the position below 490, and then I'll add to it below this low, which comes in right around 482.50, and then once again below this level for about the 479 area, and then just keep adding to that position. Once these levels are broken in terms of support, they become resistance. So they become very important information going forward in trading the markets. It's going to be a great week next week. I'm looking forward to seeing how these divergences are resolved. Have a great weekend, and I'll pick this up for subscribers on Monday evening.